Going long or short. You've probably heard these terms thrown around, especially during the GameStop saga or in movies like The Big Short. But what do long and short actually mean? Let's get into it. At its core, trading comes down to one simple concept: buying and selling assets. Simply put, long and short refer to how you open these trades. But that's just the first step. You will eventually have to close these trades, and the difference in price between when you opened and closed is what determines your profit or loss. When you take a long position, you are buying an asset because you believe its price will increase over time. This is what most people think of when they hear the word investing, leaning into the classic saying, buy low, sell high. With stocks, you buy an asset expecting its price to increase. In FOREX, or the foreign exchange market, you're buying one currency against another, expecting the one you bought to strengthen against the other currency in the pair. Using the trade tool, we can visualize this. A long entry will display a green area above the entry point, indicating potential profit, and a red area below, representing possible losses. Shorting is the opposite. Instead of buying first, you sell first, betting that the asset's price will fall. In Forex, shorting is straightforward. You're simply selling one currency while buying another. With stocks, shorting is more difficult, as you usually need to borrow an asset before selling it. This borrowing process adds complexity and may involve additional fees or restrictions. Looking at a short entry, the visualization flips. The green area appears below the entry point, showing profit when the price moves down, and the red area above represents losses if the price rises. Forex traders tend to buy and sell frequently as currency markets fluctuate within a range rather than steadily appreciating over time. With stocks, long positions are often held for months or years, and shorting typically involves higher fees, borrowing requirements, and greater risk. While this video is just covering the definitions of going long and short, and not the actual process of placing trades, it is still crucial to express that entering trades without proper risk management is extremely reckless. If a trade moves against you, you will need to cut your losses. That's where a stop loss comes in, a predetermined automatic exit point that protects your capital and is an essential element of every trade. Whether you go long or short, every trade will eventually have to close. Losing trades happen to everyone, they're just simply part of the process. In summary, placing a long trade means buying now to sell later, hopefully at a higher price, and placing a short trade or shorting the market means selling now to buy back later, hopefully at a lower price.